Hi everyone. Anissa here from Eda Property, and today I'm answering a question that I've had from many of you actually, which is what is going to happen to the property market in the short term? Well, my answer is who cares? What really matters is the long term. Property is never a short term investment. It is always a long term investment. So what is critical today is for you to start to understand the effect that property can have over the long term, because you'll see as you hold on to it year by year with compounding interest, etc., compounding capital gains, I should say, that the effects over 20 years will far outweigh anything that's going to happen in the short term. Now, firstly, I'm going to show you a calculator that will help you understand why you probably haven't got the opportunity to wait it out. You probably need to get rid of all of your excuses, stop finding reasons not to get into the market, and start as soon as possible. I know that I go through this with a number of clients and most of them panic by the end of it. So let's have a quick look. I'm sharing my screen now with a calculator that allows me to input data for each different individual. So let's say your current age is 35, I'll put it in here, okay? And you would like to retire at the age of 55, lucky you. That means that you've got 20 years remaining in the workforce, and after that you're going to have to rely on a passive income to support your lifestyle. So what does that passive income need to be? Let's assume that you would be happy with about $150,000 a year, which is also a very common response amongst my clients. So you've got 20 years to accumulate enough wealth to produce an income of $20,000 a year. So the next thing you need to consider is how many years do you think you're going to be in retirement? Well, at 55, if you assume that you're going to live at least till you're 85, you've got 30 years that you're going to need to fund yourself in retirement. Okay, so based on that, the total amount required for you to earn about $150,000 a year comfortably is an asset base of 4.5 million. Most people's, the average Australian's superannuation fund gets to about 250,000 at their retirement, so nowhere near this number. Okay, so this means that we've got, let's have a look at what we've got now. Some people in superannuation have got, I guess my client's average is somewhere between 50 and 150, so we'll say 80,000. We'll say you've got savings of 50,000. Let's say you've got your superannuation we've already included. Maybe you've got some managed funds of say 15,000. Okay. That means that at this stage, your total existing assets are 145,000. I've assumed you've got no debts. Your retirement shortfall is only $4.3 million. So if you could save this number here, $218,000 a year, you would reach your target of $150,000 a year in retirement. Now, of course, that is an absolute ridiculous number, and there's no way that you're going to achieve that. So I'll stop sharing this for a minute. Most people at this point tell me that they don't even want to wait until they're 55. They would like to be in a position where they have a quality of life within 10 years. And when they look at figures like that, they realise that, well, they have a sense that they're never going to get there. The beauty of property is not that it performs better than other asset classes. It's not that it's safer necessarily than other asset classes. It's something else. And I'm going to show you now. I'm going to show you the effect over long term, but I also really want you to understand what the beauty of property it is and how, combined with other investments and a well planned out financial plan, it can really be the one thing that accelerates your wealth to achieve those goals in retirement that you have. All right, let's have a quick look now. I'm going to share a different, very plain and simple and pretty ugly slide with you. Here, what you've got is you have got different types of investment. Let's assume that you've got $50,000. I'm going to change that in shares, which is what largely your superannuation would be invested in. So you've got $50,000 in shares. I'm assuming that you're getting an 8% return a year. If you invested $50,000 and you had 8% a year as a return, in 30 years when you retire, remember you're wanting about $4 million. in 30 years, in 25 years, sorry, you would have 300,000. Okay, so nowhere near. Now, I haven't included the fact that you're going to continue to contribute if it's some superannuation to your super, so that might double. But even at 600,000, you are nowhere near this target of $4 million. So let's have a look at something else. Let's assume that you decide to buy a property for 500. You've got $50,000 that you can invest. You borrow 450 from the bank. So this line here, bottom line, is your equity. The top line is the value of the property. Let's have a look at what happens if that property also does 8% a year. And incidentally, let me tell you that over the long term, residential property in Australia and the share market perform relatively similarly, very similarly. So 9-8% in that sort of range. So year 25, your property, the one property that you've purchased, would be worth $3.1 million. You've got to pay 450 back to the bank because I've assumed you haven't paid any of the loan back, and that gives you a sum of 2.7 million. Okay, you're not at 4, but geez, you are getting closer. I'm hoping that what this helps you understand is what is important with property is not just the property, not just the actual performance itself, but it's taking your 50,000 and it's turning it into 450. Most average Australians like you and me will not have any chance at all of retiring on $4 million without the effects of leverage. Now, there's another thing that matters, and that's time in the market. As you can see, that and I'll share the screen again, your equity really starts to grow exponentially in time. So your equity in year one is $50,000, your equity in year 2 is 90, 130, and as you get to year 10, 11, 12, etc., you're starting to get really decent numbers. So what are the 3 messages from this? 1, you need leverage. Most Australians need leverage in order to achieve their retirement goals. 2, you need to buy the right property that's actually going to perform well, because not all property goes up and achieves even the average of 8%. 3, you need to start as soon as possible, because time in the market has a huge effect on how much you can accumulate capital growth over the long term. I hope that's helped listeners. If you've got any questions, this is what we do for a living and we absolutely love it. We're very passionate about it, as you can probably see. So please, you can PM me. Otherwise, go to edaproperty.com.au and fill out a form, and we'll always be in contact within 24 hours. Thanks for listening, and I'll speak to you soon.